The Bank of Canada holding interest rates steady this week. Our guest says he does think the bank will be able to bring the economy back into balance, and it may well have done enough with various forms of tightening. Randall Bartlett joins us now, Senior Director of Canadian Economics at Desjardins. Randall, great to see you. You feel the Bank of Canada has largely done what needs to be done?
Yeah, we think so. When you look at the state of the Canadian economy right now, I mean, whether you're looking at GDP, the labor market, the Bank of Canada's core inflation measures, they all seem to be at a bit of an inflection point and starting to gradually trend lower. And so, the bank cited this as evidence supporting its decision to keep the overnight rate on hold yesterday. And so we think the bank has done enough, and we'll continue to see a slowing in the economy going forward, which will help to support a gradual return of underlying inflation to the Bank of Canada's 2% target by the end of next year.
Here is a forecast that some may find reassuring. You think that we could see rate cuts early next year?
Yeah, that's right. We think we could see rate cuts as early as the end of the first quarter of 2024. And we think this will be prompted by the fact that the Canadian economy is likely to experience a short and shallow recession through the end of this year and going into the early part of next year. And as that'll cause, the unemployment rate to rise and labor market to cool further from its, very tight state right now, we think that that's going to help to support the Bank of Canada to make the decision to cut interest rates as early as the first quarter of next year, but possibly into the second quarter.
I imagine, though, His Lordship Tiff Macklem will be reluctant to cut too soon, because he'd end up with omelette on his face, wouldn't he, if inflation came back?
That's right. And you can see that when you read the statement that accompanied the interest rate announcement yesterday, that the Bank of Canada, while recognizing that we are seeing evidence of excess demand, which is starting to come off in the Canadian economy, underlying inflation still remains elevated and continues to be sticky. And so the Bank of Canada remains ready to raise interest rates if necessary, if the data doesn't cooperate. But we think, given the direction of a broad suite of economic indicators currently, we think that the data is starting to cooperate with the Bank of Canada, hence why we think interest rates are as high as they're going to get for this cycle, and the Bank of Canada's next move is likely to be a cut in the first half of next year.
You think on the balance of probability is no more raises from the Bank of Canada? I know that's a tricky call.
Yeah, that's right. I mean, we saw that GDP in the second quarter came in well below the Bank of Canada's expectations. They were expecting 1.5% annualized increase. It contracted by 0.2. We're expecting to see a similar difference between what the Bank of Canada projected in July and what the actual outturn is going to be for the third quarter as well. And so all of this is helping to, I think, support the case that the Canadian economy is cooling. And even though there were some idiosyncratic temporary factors that were driving that weakness in the second quarter and spilling over into the third quarter, when you look more broadly at what's happening in the labor market, what's happening in underlying inflation, what's happening in the Canadian housing market, all of these indicators together really suggest that the Canadian economy is showing more signs of broad-based slowing than we've seen so far through the tightening cycle.
Could we talk about mortgages? Because we know that the variable rate mortgage holders have, of course, seen their borrowing costs go up. Is there a bit of a time bomb, is maybe going too far, but is there pain ahead for the fixed rate mortgage homeowners? Because lots of them still have renewals coming up.
Yeah, absolutely. I mean, we're not expecting to see interest rates go back down to levels that we saw during the pandemic or even that preceded the pandemic. And so we think the Bank of Canada will keep interest rates higher for a longer period of time. And so as households begin to renew their mortgages, both fixed rate mortgage holders as well as fixed payment variable rate mortgage holders, they're going to come up against higher mortgage rates than what they had experienced prior to this hiking cycle. And so we do think that there's more pain ahead, and we're going to be publishing our latest forecast next week. But what we're assuming is that the recovery is not going to be necessarily as robust as rates start to come down, because of the fact that households are going to see their costs rise, and that's going to chew into consumption and investment to some extent as well.
And I mean, we've seen a huge increase in popularity among the variable rate mortgages, but they're still only about a third of the home loan market.
Yeah, that's right. But I think when you look at the popularity of variable rate mortgages, that hasn't continued into the hiking cycle. They really reached their peak of popularity during the pandemic, and so we've really started to see demand for those come off, and households starting to move more into the shorter term fixed space, the 1 to 3 year space, because of the fact that it doesn't seem that households want to get caught in a variable rate situation where rates stay high, but also lock into a 5-year fixed at high interest rates as well. So households are really sort of trying to get a sense in this uncertain environment of where the best spot to be is in terms of borrowing.